everyone. Welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of Chapter 13 from the book How to Make Money in Stocks by William O'Neill. It has been created with the help of AI. The chapter is titled 21 Costly Common Mistakes Most Investors Make. You can read the original post at samfury.com.
Hey everyone, and welcome back. Today we're going deep on something that could totally change your investing game. We're talking about investing mistakes.
The big ones.
The ones that can really cost you.
And the good news is these are totally avoidable.
We're going to lay it all out so you can sidestep these pitfalls and keep your portfolio on the right track.
Think of it like we're giving you a cheat sheet to the investing game.
So where are we getting all this wisdom from? Well, we're taking cues from the legendary investor himself, William O'Neill, and his book, How to Make Money in Stocks.
Now, if you've been following the markets for a while, you've probably heard of O'Neill. He's known for his focus on growth stocks, and that can slim method everyone's always talking about, that's his baby.
But here's the thing that really stood out to me in this book.
What's that?
O'Neill doesn't just focus on what to do. He actually spends a lot of time talking about what not to do.
And that's honestly so refreshing.
It's like he's saying, hey, you don't have to be perfect to succeed in the market. You just got to avoid these major blunders.
Take some of the pressure off.
Totally. So in this deep dive, we're going to dissect the 21 most common and costly investing mistakes that O'Neill outlines in his book.
And trust me, these aren't just rookie mistakes.
Yeah.
These are traps that even seasoned investors can fall into. So we're going to break down each mistake, explain why it's so dangerous, and most importantly, give you actionable advice on how to avoid it.
I'm ready to get started. Are you?
Let's do it.
Okay, so O'Neill groups these mistakes into a few categories, and the first one is all about emotional traps.
Yes, the emotions.
They can get us every time.
It's like our brains are wired to make bad investing decisions sometimes.
It really does feel that way. So mistake number one is something I think we've all been guilty of at some point. Holding on to losses for too long. It's that classic scenario. You buy a stock and it starts to tank.
But instead of cutting your losses,
You dig in your heels.
you convince yourself it's going to bounce back any day now.
You start making excuses.
Oh, it's just a temporary dip, or the fundamentals are still strong.
Famous last words.
Meanwhile, the stock keeps sinking lower and lower.
It's like watching a slow-motion train wreck.
And the worst part is we often end up holding on until the losses are so big that it takes forever to recover.
It's painful.
But O'Neill has a really simple rule to avoid this trap.
What's that?
He says you should cut your losses at 8% max.
8%. That seems strict.
It does, but he's adamant about it.
Why so low?
Because he believes that preserving capital is absolutely key.
Makes sense. The less you lose, the less you have to make back.
Exactly. Recovering from an 8% hit is way easier than digging yourself out of a 20% hole or worse.
Okay, I'm starting to see the logic here. But I gotta admit, I've definitely been guilty of holding on, hoping for a miracle.
Oh, we all have. It's that emotional attachment we were talking about.
We personalize it like the stock somehow owes us something.
But the market doesn't care about our feelings.
Nope. It's ruthless.
A lower price doesn't automatically mean a bargain.
It could actually be a sign that something's fundamentally wrong.
And that leads us into mistake number 2. Buying on the way down. Or, as some people call it, catching a falling knife.
Ooh, that sounds dangerous.
It can be. It's that temptation to buy more of a stock as the price keeps dropping.
Like we're trying to average down our cost.
Or we're convinced we're getting a steal.
But as O'Neill points out, this is often a sign that we haven't accepted the initial mistake.
We're doubling down on a losing bet.
And instead of cutting our losses...
We compound them.
Ouch. So what's the psychology behind this mistake? Why do we do this to ourselves?
Well, one factor is something called anchoring bias.
Anchoring bias.
It's basically this idea that we get fixated on that initial price we saw.
Like the first time we looked at the stock, it was trading at $100.
Right, now it's down to $50, so we think, wow, what a deal.
But what if the company isn't worth $100 anymore?
Exactly. The price might be lower, but the value might have also decreased.
So it's like buying a damaged car just because it's half price.
Perfect analogy. If it's not fixable, it's not a good deal no matter how cheap it is.
Okay, so we've got to resist that urge to buy on the way down.
And that brings us to mistake number 3, which builds directly on the last 2. Averaging down.
Ah, this one's a classic.
It's so tempting to think, well, the price is lower now. I'll buy more to bring my average cost down.
Like I'm somehow outsmarting the market.
It feels like you're taking control.
But O'Neill sees this as throwing good money after bad.
It's often a sign that we haven't truly accepted the initial loss.
And instead of cutting our losses and moving on,
We just keep digging that hole deeper.
and that capital could be used on a new opportunity that's actually rising.
So these first three mistakes, they're all very emotion-driven.
It's all about fear, greed, hope, all those messy human emotions.
But what about mistakes we make because we just don't know enough?
Knowledge gaps.
That's the next category O'Neill tackles, and the first one is a biggie. Not learning how to read stock charts. O'Neill is adamant about this. He believes that charts are essential for understanding a stock story.
Are we talking full-on technical analysis here?
Not necessarily. O'Neill has his own patterns he looks for, but the point is that charts provide a visual representation of a stock's price history.
So it's like another layer of information beyond just looking at the financials.
Exactly. Charts can reveal trends, potential turning points, things that you might miss if you're only looking at numbers on a spreadsheet.
So how does this help us avoid mistakes?
Well, imagine you see a stock that's had a recent dip in price.
Okay.
You might be tempted to think, oh, it's on sale time to buy.
Especially if the company's fundamentals look good.
But the chart might show you that this dip is actually part of a larger downtrend that's been going on for months.
So it's not just a random blip, it's a pattern.
And that pattern might be a sign that something's not right.
So charts can help us see the bigger picture.
Precisely. They add context to the numbers.
Okay, I'm starting to see the light. The chart.
Good one. Now, charts are important, but of course, understanding the company itself is crucial too.
You got to know what you're investing in.
And that brings us to mistake number 5, ignoring fundamentals. O'Neill is hardcore about this earnings growth, sales, profit margins. He says these are the foundation of any good investment.
It's like you wouldn't buy a house without inspecting it.
So why would you treat stocks any differently?
So we're talking about doing our due diligence, looking under the hood.
And within those fundamentals, O'Neill has a favorite metric.
What's that?
Earnings per share growth.
Yeah.
And not just for one quarter. He wants to see consistent growth over time.
So we're looking for companies that are actually growing their business.
Not just manipulating numbers or relying on hype.
Companies that are built to last.
That's the idea. Now, while individual stocks are important, we can't forget about the bigger picture.
The market as a whole.
And that leads us to mistake number 6, not recognizing market corrections.
Oh, that sounds scary.
It can be, but it's a natural part of the market cycle.
So how are we supposed to predict when the whole market's going to tank?
It's not about prediction, it's about observation. O'Neill says to pay attention to general market trends.
Like what kind of trends?
Things like the number of stocks hitting new highs or new lows. When those numbers start to shift significantly, it could signal a change in market sentiment.
So if fewer and fewer stocks are hitting new highs, even if some companies are doing well,
That's a potential warning sign.
like the tide is turning.
And this ties into another mistake that even experienced investors make, not following your buy and sell rules regardless of the market climate. We do all this research, we make a plan, and then we panic sell when the market dips, or we get greedy and buy into hype.
So discipline is key.
Discipline is everything. O'Neill says even the best rules are useless if you don't have the mental fortitude to stick to them.
So no more emotional overrides.
No more. Write down your rules and treat them like a contract with yourself.
Okay, I'm ready to sign on the dotted line.
Good. Now, we've talked about emotional traps and knowledge gaps.
What other category of mistakes do we need to watch out for?
This last group is fascinating out. O'Neill calls them counterintuitive pitfalls, things that seem smart on the surface but often lead investors astray.
I'm intrigued. Give me an example.
Mistake number 8, not buying the highest quality.
Wait, what? You're telling me we shouldn't be looking for bargains?
Not exactly. It's more nuanced than that. A lot of people are drawn to low-priced stocks.
Makes sense. Buy low, sell high.
That's the classic thinking. But O'Neill argues that fixating on price alone can be a mistake. He says to look for truly outstanding companies even if their share price seems high.
So instead of buying 100 shares of a mediocre company,
Maybe you're better off with 10 shares of a stellar one, even if it costs more per share.
it's about quality over quantity.
Exactly. It's the percentage gains that matter, not just the number of shares you hold.
So it's like choosing a small slice of a delicious cake over a whole stale loaf of bread.
Now you're getting it. And that brings us to mistake number 9, which kind of builds on what we were just talking about. It's this idea that more shares is always better.
Wait, you're saying that's not true?
It's not always the case. O'Neill says focusing on the sheer number of shares you own can actually distract you from the bigger picture.
The quality of the underlying company.
You could own a ton of shares in a company that's going nowhere, whereas a smaller position in a company with huge growth potential.
Could end up being way more valuable.
It's about the percentage gains, not just the raw number of shares.
So even if I can only afford like 5 shares of a company like Amazon,
It might be a better move than owning hundreds of shares in a company with less growth potential.
this is making me rethink my whole approach.
Good. Now, this next mistake is a big one, and I think a lot of listeners will relate to this:
Hit me with it.
blindly listening to the so-called experts.
We've all seen those financial gurus on TV,
The ones with the fancy suits and the confident smiles.
promising to reveal their secret formula for getting rich quick.
But O'Neill is highly skeptical of these experts. He urges investors to think for themselves.
Do your own research.
Don't just take someone's word for it, no matter how credible they seem.
So how do we avoid falling into this trap? What's the practical advice here?
Well, when you hear a hot stock tip, don't just blindly jump in.
Okay.
Use it as a starting point for your own investigation.
So dig into the company's financials, read analyst reports, look at their track record.
Become your own expert.
Don't just follow blindly, become an informed investor.
That's the key. Now, this next mistake is a little counterintuitive. It's choosing stocks based solely on dividends and PE ratios.
Wait, those are supposed to be good things?
Well, it can be. But O'Neill argues that they can also be misleading.
Really? But high dividends mean I'm getting paid right.
True. But a company might be paying high dividends to try to mask other problems.
And a low PE ratio means I'm getting a bargain right.
Again, it can be a good sign, but it could also mean that the market is not very optimistic about the company's future prospects.
So what should we be focusing on instead?
Earnings per share growth consistently over time.
Okay, so instead of chasing those dividends or trying to snag a stock with a low PE ratio,
We should be looking for companies that are actually growing their earnings.
companies that are building a solid foundation.
And speaking of building foundations, that brings us to another mistake that can really derail your investing journey:
What's that?
wanting to get rich quick.
Oh man, who hasn't dreamt of that?
It's so tempting to chase those quick wins.
Especially when you see other people seemingly making money overnight.
But O'Neill stresses that this mindset is detrimental to long-term success.
It leads to impulsive decisions,
Chasing hot stocks.
ignoring those all-important fundamentals.
It's like trying to build a house on sand instead of a solid foundation.
So patience is key.
Patience and discipline, they're your best friends in the investing world.
It's a marathon, not a sprint.
Well said. Now, this next mistake kind of ties into that whole get-rich-quick mentality.
I'm listening.
It's buying the familiar.
You mean sticking to companies we know and feel comfortable with
It's natural to gravitate towards familiar brands.
and feel safer?
But O'Neill argues that the most exciting investment opportunities often lie in newer, lesser-known companies.
So we need to venture outside of our comfort zone a bit.
Don't let familiarity bias limit your potential,
There might be hidden gems out there.
waiting to be discovered. Now, this next one is a little nuanced.
Nuance, I like it. Give it to me.
It's not following sound advice.
Wait, but didn't we just talk about not blindly following the experts?
We did, but this is about being able to discern good advice from bad.
Okay, so it's not about rejecting all advice.
It's about being selective.
Finding those trusted voices in the investing world.
Develop your judgment critically, evaluate the information you're receiving, and seek out mentors or resources you trust.
So it's like finding that balance between being open to learning from others.
And maintaining our own critical thinking skills.
Now let's shift gears a bit and talk about selling.
The other side of the coin.
O'Neill highlights a mistake that I think a lot of us have made, taking profits too quickly.
I've been there. Buy a stock, see a little profit, and then
Panic and sell.
only to watch it keep sliming without you.
It's the worst. Why do we do that?
We get scared of losing our gains, so we sell prematurely.
But O'Neill says we should let our winners run.
Don't be afraid to hold on to those winning stocks, even if they've already gone up significantly.
Of course, we still need to monitor the company and have our sell rules in place.
Absolutely. This doesn't mean holding on blindly.
But we shouldn't let fear or impatience rob us of potential gains.
Well said. Now, this next mistake is something that can really trip people up.
I'm all ears.
Getting too bogged down by taxes and fees.
But those things are important, right?
They are. But O'Neill cautions against letting them dictate your investment decisions.
So focus on making smart choices first.
And then worry about the costs.
Prioritize profits over penny pinching.
Now, this next one might be a bit controversial.
Hit me with it.
O'Neill is cautious about trading options and futures. They are complex instruments, and O'Neill believes they're often associated with speculation and short-term trading.
Which he's not a fan of.
Nope, he's all about that long-term growth.
So for a long-term investor like me,
It's probably best to stick with stocks for now.
okay, I'll stick to my lane.
Master the fundamentals of stock investing first, and then if you decide to explore options and futures later on.
Do so with caution and a lot of research.
Now, this next mistake is something we've probably all struggled with at some point.
What is it?
Relying too heavily on limit orders.
But aren't those supposed to be a good thing? They let you set your buy or sell price in advance.
They can be helpful, but O'Neill believes that when you've identified a good investment opportunity, don't hesitate, just go for it.
Because placing a limit order could cause you to miss out if the stock price moves quickly.
And that brings us to a related mistake: indecision.
Analysis paralysis.
We get so overwhelmed with information that we're afraid to make any decision.
It happens to the best of us.
O'Neill emphasizes the importance of having a clear plan and sticking to it.
So do your research, make a plan, and then take action.
Don't second-guess yourself every step of the way.
Confidence is key. What's the final mistake we need to watch out for?
This one is surprisingly common: picking favorites.
You mean like getting emotionally attached to certain companies?
We might love their products or admire their CEO.
But that doesn't necessarily mean their stock is a good investment.
We need to look at all stocks objectively based on their fundamentals and their potential for growth.
No letting our heartstrings influence our investment decisions.
Nope, it's all about making rational, data-driven decisions. So in this final part, we're going to try to distill everything we've learned into actionable takeaways.
The stuff you can actually use to improve your investing game.
Think of it like this: those 21 mistakes we talked about.
They're like the symptoms.
But what we need to figure out is the underlying investor ailments causing those symptoms.
Okay, I like that analogy. So what's the first ailment we need to diagnose and treat?
So many of those 21 mistakes stem from letting our feelings drive our decisions.
Fear, greed, impatience, even hope sometimes.
All those messy human emotions that can cloud our judgment.
And lead us to make irrational decisions.
So think back to holding on to losses for too long, buying on the way down, averaging down.
Yep, been there, done that.
Those are all classic examples of emotional impulsivity at play.
So how do we combat this ailment? What's the antidote?
Well, it's a two-part remedy.
Okay.
First, we need to develop a set of rock-solid investing rules.
Like a code of conduct for our portfolio.
And second, and this is crucial, we need the discipline to actually stick to those rules, no matter what our emotions are telling us.
So it's like creating our own personal investing constitution.
I like that. The law of the land for our portfolio.
And no emotional overrides allowed.
Nope. All right, so that's emotional impulsivity.
What's the next investor ailment we need to address?
This one's a biggie, and it's something we've talked about before.
Okay, remind me.
It's fundamental ignorance.
You got to know what you're investing in.
This ailment is all about not doing our homework and understanding the businesses behind the stocks we're buying.
It's so easy to get caught up in the hype, the hot tips.
The next big thing.
But if we don't understand the fundamentals,
We're essentially gambling.
blindly throwing darts at a dartboard.
So think back to those mistakes, like ignoring fundamentals, not learning to read charts, focusing on dividends over earnings growth.
Yep, those are all red flags.
Those are all symptoms of fundamental ignorance.
And the cure is?
Knowledge.
So we got to roll up our sleeves and do our research.
Dig into those financial statements. Learn how to read charts, understand the industry, the competition.
Become informed investors.
Now, this last investor ailment might be the most pervasive. It's herd mentality.
Following the crowd.
It's that urge to blindly follow the latest trends, the so-called experts, without thinking for ourselves.
We've all been tempted to do this, especially when it seems like everyone else is making money.
It's that fear of missing out.
FOMO.
But O'Neill cautions against this. He wants us to be independent thinkers.
So what are some of the symptoms of herd mentality?
Well, think back to mistakes like blindly following experts, buying familiar stocks just because we know them being swayed by tips.
It's all about going with the flow, even if it doesn't make sense. How do we become contrarian investors?
It's all about developing our critical thinking skills.
Question everything.
Do your own research.
So we've got emotional impulsivity, fundamental ignorance, and herd mentality.
The three big investor ailments to watch out for.
And by understanding these underlying causes, we can start to see how those 21 mistakes are interconnected.
They're not just isolated blunders.
They're symptoms of deeper issues that we need to address.
And remember, investing is a journey, not a destination.
It's all about constantly learning and evolving and refining our approach.
So as we wrap up this deep dive, we want to leave you with a challenge.
Okay, I like challenges.
If you could only focus on conquering one of those 3 investor ailments,
Emotional impulsivity, fundamental ignorance, or herd mentality.
which one would you choose and why?
Think about which one is holding you back the most. Which one, if overcome, could have the biggest positive impact on your investing journey?
There's no right or wrong answer here.
It's about self-awareness and identifying those areas where you can improve.
This has been such a fascinating deep dive.
It really has. We've uncovered those common investing mistakes, explored the underlying causes, and hopefully given you some tools to become a smarter, more confident investor.
And remember, knowledge is power, especially when it comes to building wealth.
Until next time, happy investing.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.